I've come across this statement way too many times, and that is, I can't invest yet, or I'm not ready. Why? Because my capital is too small, or I do not have enough capital. Now that is not true, and today I'm going to share with you the tips and tricks to invest efficiently with as little as hundreds of dollars per month. So make sure to watch till the end as we will be covering lots of informative content, and that includes the concept of dollar cost averaging, diversification, and portfolio allocation, all from the point of view of a small but intelligent investor. As always, smash that like and subscribe button and help me push for 50 likes for this video. Okay, here we go. Now all you need to start investing is not a huge capital, which is a huge misconception that many may have. The first thing that you need is determination and perseverance, as this investment journey is not going to be a one-off thing or a do-as-you-like thing, but a lifelong journey and process, after which you need to keep your emotion in check and you need the knowledge to sail through these journeys as smooth as possible. If you're a small investor, your source of investment would most likely come from your paycheck. So you need to manage your paycheck well. So as an example, this is what I'm doing personally. Once I receive my salary, I would first use it to pay up all my bills and debt that I have. And this currently takes up about 15% of my salary. Next, I want to immediately allocate for my investment fund. And this takes up 60% of my salary. The remaining 25%, I would say 15% and spend the remaining 10%. The numbers here are arbitrary. The important concept here is the relative size of each section and the order of allocation, from bills and debts to investments to savings and finally daily expenses. This is to prevent yourself from splurging away all your hard-earned money. Remember, determination and perseverance. The invested money should not be needed for the next 5 to 10 years. This money needs time to compound and grow. And after you have decided on the monthly allocation, do your best to only increase or keep it constant, never decrease it. For today's discussion, let's say that we will be allocating 500 per month for our investments. The next thing that you want to do is to save this money up in a separate account, somewhere you can't see or touch easily, and inject it into your investment account with whichever broker you choose to use at a fixed interval. Say every 3 months, every 6 months, or every year. Find an interval that you are comfortable with, bearing in mind that the more regularly you do this, the more transaction cost and commission fees that you will rack up and you have to pay, which may eat significantly into our small account. And again, for today's purpose, let's say that we will invest every 6 months. So we accumulate the $500 every month for 6 times, which makes it 6 months. And then we will inject this 3,000 into our account every half a year. Using this $3,000, we are going to dollar cost average into our investments. Okay, so what is dollar cost averaging, or DCA in short? Now, dollar cost averaging is an investing strategy. Now think about this. Everyone, including you, wants to buy low and sell high. But how low is low and how high is high? If you have got the knowledge and skills to tell you what is high and low, then that's good for you. This content I also cover in my technical analysis course for beginners. So do check them out to enhance your trading and investment skills. And more content will be added at a regular interval. So do keep an eye out for them. But then again, not everyone has the time or want to spend the effort to do their own analysis. For this, then the plain old vanilla DCA would be a good strategy for these people, because this strategy dictates that you buy into the stock that you want at every fixed interval. Not only that, the dollar amount that we will spend is also fixed. Basically, what is happening when you use this strategy is that you do not care about what the stock price is. Do not care whether it is in an uptrend or downtrend, and you will just buy more when the price is cheap and buy less when the price is expensive. So when you execute this properly, oftentimes your average purchase price of your stock should be lower than the current price. Don't believe? Then let us look at a real life example. Now let's assume that we start this DCA strategy in 2014, which is this period. And let's track our return if we were to dollar cost average at every 6-month interval up to the end of 2016. Now, why do I choose this period? You can see that the S&P 500 during this period for the past 10-year bull run has not been performing as well. It has spent the entire 2015 and 2016, most of those 2 years in a consolidation phase. So how will our dollar cost averaging work out in such an average period? Let's say we invest $1,000 in the S&P ETF on the 1st of January and the 1st of June, which is a 6 months interval. And let's assume that we are able to buy fractional shares. So at the start of 2014, which is when the market first opened on the 2nd of January, we start to dollar cost average into the stock. With $1,000, and let's assume that we just buy at the opening price, which you can see right now is at $183.98, that will allow us to buy 5.43 shares, which makes up our $1,000 investment fund. So this will be our first purchase in January. When the time comes to June, you can see that the stock price opened at $192.95. So likewise with our $1,000 fresh investment fund, this will allow us to purchase 5.18 shares. And as we move on, you can see that there is somewhat of a large correction over here. But this strategy does not tell us when to sell. So we will not sell unnecessarily and we'll just hold on to our position till forever for simplicity's sake. And what happened when it comes to 2015? At what price will we be buying into? And that will happen on the 2nd of January at $206.38. So again, our $1,000 investments will allow us to buy 4.84 shares. So by now you can see that as the price increase higher, we are only allowed to buy lesser and lesser shares of the SPY ETF. Next, as time progresses into June, the stock opens at $211.94 on the 1st of June. And again, we'll be able to buy 4.71 shares. And so you just have to rinse and repeat. On the 4th Jan in 2016, you will be buying 4.98 shares at $200.49 each. On the 1st of June, you will buy 4.78 shares at $209.12 each. And lastly, let us just add our last period of dollar cost averaging on the first day of January 2017, and that will be 4.44 shares at $225 each. So how will our dollar cost average for this 3-year time span perform for us? Let's take a look. Now, this is the results that our DCA strategy would have brought us. If you are too busy and do not have much time to put into the market, strictly following this schedule would have earned you 10.58% over 3 years on the small capital that you have built over time. And while the market is at $225, look at what your average cost price is, $203.52. So if we go back to the chart, our last purchase price, which is the market price, is at $225, which is around somewhere around here. And your average price will only be $203, which is somewhere around this area. So this difference right here will be your margin of safety and act like a safety net for the market to drop before you getting into the rate. And for those who say, let me save up more money first before investing, and goes ahead spending 2 years accumulating their savings for investment, they are going to regret it big time. Time waits for no one, yes or no? Now, can you do better than this? Of course you can. When I was going through the example with you just now, there are times where I would delay my buying due to technical signals from the charts. One clear example is during January of 2016, which is our purchase made during this period of time. Now, can you see that the market is starting to turn into a downtrend? How do I know? Prices below the 200 moving average, and the 200 moving average starting to slope down ever since August of 2016. When the market is in a downtrend, I will hold off my buying and only add to positions at strong area of tested support. Do not catch a falling knife, as they say. So where is a strong level of support on this chart? You can see one rather clearly over here, which has been tested once and twice before. So when the first day of January comes, I can see that the market is in a downtrend with the price below the 200-day moving average. I'll hold off my buying until I see the candle touches this area of support, and then I'll just dollar cost average at this area. So instead of buying at $200, I'll now be buying at $182 or $183 instead. So these are the perks of knowing technical analysis and spending the effort and time into analyzing the markets. You may have noticed a disconnect by now. Earlier on, we said to allocate $3,000 every 6 months, but then when we purchased the S&P 500 ETF, the SPY, we only used up $1,000 every time. Did $2,000 just disappear into thin air? Of course not, okay? With the remaining $2,000, I'm going to introduce to you another concept in the world of investing, and that is diversification. As the saying goes, don't put all your eggs in one basket. What if overnight US goes into war or is no longer the world power? No offense, alright? But if you only invest in the US, then your portfolio is going to suffer a lot. And that is what we want to prevent. So to diversify properly, you need to do it across countries and also across different sectors. For example, the US and China are the world's dominating players right now. So you may want to allocate a larger portion or percentage of your portfolio to these countries. You may also want to invest and diversify into your own country or other countries that you think may have the next largest growth potential out there. Just take my portfolio for example. Currently, I have 5% in my own country, Singapore, 20% in an ETF that tracks the emerging markets. Think of this as a global investment. And then around 35% in the US. And because I'm slightly bullish on China, as you may have already known from my other videos, I have about 40% in China. Once again, if you are someone who do not have much time to do your own research to pick individual companies to invest in, just invest in the ETFs that tracks the different countries' market, and that will be a good enough diversification for you. For those that aim to beat the market and would like to select your own companies to invest in, make sure the companies that you have selected are spread throughout the various sectors and industries to gain a good coverage. To learn more about how to conduct your own fundamental value analysis to sieve out the strongest companies to invest in, be sure to check out our value investing course and refer to the value investing video series for investment ideas and insights, all fully analyzed for you. When diversifying using individual stocks, you don't have to religiously cover all the different sectors, alright? That will be unrealistic and you'll be better off just buying the S&P 500 instead. Your goal will be to more or less spread the weightage of your portfolio equally in the sectors that you believe will have the highest growth or sectors that could help you weather a correction in the broad market. And for example, that would generally be defensive stocks in the consumer staples industry like McDonald's or Procter & Gamble, or stocks in the utilities and healthcare sectors, just to name a few. With that being said, there are several ways for you to construct your investment portfolio. If you are someone with little time and want to spend little effort in studying the market, the first portfolio will be good for you. If you are someone that can tolerate risk and would like to overweigh your portfolio slightly in certain sector or industry that you believe in, go for the second option. And if you are someone that like researching into companies to find hidden gems and would like to have a shot at beating the market, then go for the third one. Or you can be like me, a mix of all three. My portfolio consists of ETFs that tracks different countries, such as the emerging market, China, and also Hong Kong, as well as a couple in some defensive sectors, and the remaining being focused onto value growth companies. Also, take note that these numbers provided here are just meant as a rough guideline. No need to adhere strictly to it. But generally, I would want my investment portfolio to consist of less than 20 stocks, ETFs included. Any more could be too time consuming and confusing to track. Now, some of you may start to think, I only have $1,000 per position every 6 months. How can I possibly invest in expensive stocks like Google, Amazon, or Berkshire Hathaway? Well, with the advancement of technology, it is totally possible, especially since brokers have started to roll out this thing called the fractional trading system. So check out if your broker offers this service. And just a small disclaimer here that I have never used fractional trading before, so please do your own due diligence before committing. For those of you who are not fond of buying fractional shares, like myself, another option would be to set aside your investment fund till you have enough to purchase one share. Using our previous example, with $1,000 per position per 6 months, we will be able to purchase a share of Amazon every year. That is to say, you hold on to the $1,000 investment fund for at least one interval. And what I'm going to share with you next are creative but cheap ways to replicate some of the investing style. First up, if you think that the S&P 500 is too expensive at 320 over dollars, an alternative will be the Noble NOBL ETF. So this tracks the S&P 500 Dividend Aristocrats, and it has an expense ratio of 0.35. Anything less than 0.5% will be fine by me. And lastly, these are the sector weightage for you to consider if this is the right ETF for you. So if the SPY is too expensive at $320, do look out for alternative similar ETFs that will give you almost the same performance. And Noble right now is trading at only 70 over dollar if I recall correctly. So with an even smaller investment fund, you definitely have alternatives and ways to get invested in the market. No excuse for that. Another alternative to gain exposure to the tech stocks like Google without paying as much would be the XLC. So XLC has an expense ratio of 0.13%, which is rather low, and this is their holdings. You can see that it is largely into Google or Alphabet, and that weighs around 23% in this ETF. The next largest holding is Facebook at 18.92%. So if a share of Google at $1,500 or a share of Facebook at $215 is too expensive for you, consider the XLC, which is only selling at $57 market price right now, and cheap alternative for you to replicate similar investment styles. Of course, the downside is that you can't avoid some of the not so good companies. Those who have watched my older videos would know why. But hey, it's good enough given that we have limited capital. Alright, so the list is not exhaustive. This is where your hard work and research comes in. And I believe that you'll be able to craft out the perfect portfolio for your investment needs. Remember, no excuses and take action right now. It all boils down to whether you want to do it or not. Finally, do share your ideas and insight with the community in the comments below. As always, like, share, subscribe, and thanks for watching.